Welcome back to the deep dive. Ever feel like navigating the financial markets is like trying to read a secret code? All those rules, acts, regulations.
It definitely has its own language, right?
Totally. So today, we're going to try and crack that code. We're diving into the Securities Act of 1933 and the Securities Exchange Act of 1934. Think of it as getting the essential rules of the game without needing a law degree.
Yeah, it sounds intimidating, securities law, but honestly, understanding the basics, the core logic behind it all, it's actually pretty empowering. We're going to try and cut through the jargon.
Exactly. And look, I get it. Securities law doesn't exactly scream excitement. But stick with us. These rules are kind of the bedrock. The reason our markets aren't just pure chaos, we're using excerpts from Securities Acts and Rules Explained.
Yep.
And our mission really is just to pull out the key stuff, the practical bits. What do companies actually have to do? What do investors need to look out for? We want to make sense of it.
Consider it your cheat sheet for understanding why things are the way they are in the markets. Might even help you sound smart.
Maybe. All right, let's start with the big one, the OG, the Securities Act of 1933. This one's all about when new securities are born, IPOs, that kind of thing.
Right, the 33 Act focuses entirely on the primary market, new offerings hitting the street. Its main goal, transparency.
Making sure companies spill the beans before they take your money.
Exactly. It came right after the 29 crash. There's a lot of shady stuff going on, lack of disclosure. This act was meant to force companies out into the open.
And a big part of that forcing is Section 7. This is the laundry list, basically, of everything a company has to put in its registration statement when it wants to sell new securities.
Oh, yeah. Section 7 is where the SEC really lays it all out. They want the company's whole life story, almost. What's the business? How does it work? Who's running the show?
Like, are the managers actually qualified? And, crucially, what are they going to do with the cash they raise? Build something amazing or just, buy fancy office chairs?
And the financials, of course. The hard numbers. Plus, a really honest look at the risks. What could go wrong? They have to tell you.
No secrets, no BS. That's the principle. It sounds like a lot of paperwork, but it's there for a reason, right? Investor protection.
Absolutely. It was a direct answer to all the fraud back then. Forces companies to show their weak spots so investors aren't just buying hype.
Okay, so the company files all this stuff. Then what? That brings us to Section 8. This part is about when that registration statement actually becomes, active.
Right. Section 8 dictates when the registration statement becomes effective. That's the green light. It means the SEC has reviewed it for completeness or enough time has passed.
So the SEC might say, okay, go ahead, or it just happens automatically after a certain period.
Pretty much. But the key thing is, selling can only start after it's effective.
Gotcha. No jumping the gun. You wait for the official nod.
Trying to sell before that.
Yeah.
Big trouble with the regulators.
Okay, registration's effective. What does the average person actually see? That's the prospectus, right? Section 10.
Exactly. The prospectus is the sales document for potential buyers. It's supposed to be a more readable summary of the key info from that massive registration statement.
Like the cheat sheet for the deal.
Yeah. It details the terms, price, number of shares. It highlights the risks again, key financial data, what the company plans to do.
It's the main thing an investor uses to decide, yeah. And Section 10 makes sure companies can't just hide the bad stuff.
They have to give a balanced picture. Hiding material facts in a prospectus, that's lawsuit territory.
Speaking of trouble, Section 23 is interesting. It basically forbids anyone from saying the SEC approves the stock.
Oh, that's a huge one. The SEC checks for disclosure, like we said. They check if the company filled out the forms correctly. They do not judge the quality of the investment.
They're not saying this is a guaranteed winner. They're just saying, okay, they told you what they're supposed to tell you.
So if a broker ever says, this is SEC approved, that's a massive red flag. Run away.
Seriously. It's like saying the FDA approved your cooking just because you listed the ingredients, even if the dish tastes awful.
Good analogy. Disclosure, not endorsement. That's the SEC's mantra for offerings.
Okay, let's shift gears a bit. Section 215, accredited investor. Who are these people?
The accredited investor. These are individuals or entities the SEC assumes are sophisticated enough financially to handle investments that don't have all the public disclosures. Less protection needed, supposedly.
So what makes you accredited? Lots of money.
Pretty much. Generally, it's either income over $200K single, $300Ks married for the last 2 years, expected to continue, or net worth over $1 million. not counting your main house.
Okay, so wealthier folks. The idea is they can afford to lose money, or they have the smarts to figure out the risks in these private deals.
That's the rationale. They get access to things like private placements, hedge funds, stuff the general public usually can't touch because those offerings aren't fully registered. The assumption is they can do their own homework or hire people who can.
But does that definition make sense? Like, are income and wealth really perfect proxies for financial smarts? Seems like it could lock out people who are knowledgeable but not yet rich.
That's a very common debate. Does it unfairly limit access to potentially lucrative early-stage investments? It's a live question.
Interesting point. Okay, moving on. Section 431, summary prospectuses. These sound more manageable.
They are. Think of the summary prospectus as the Cliff's Notes version. You see them a lot with mutual funds.
So, just the highlights.
Yeah, key stuff like fees, investment goals, main strategies, major risks. It's designed to be quick and easy to grasp.
Because nobody wants to read a 300-page document just to buy a mutual fund.
Right, it gives you the essentials and then points you to the full prospectus if you want to, really dive deep. It's about accessibility.
Makes sense. Now, for the real detail lovers, there's Schedule A. What's that?
Schedule A is like the ultra-detailed instruction manual for filling out the registration statement for typical corporate securities, stocks, bonds.
So it's not something investors usually read, but it tells the company exactly what nitty-gritty details to include.
Precisely, line by line.
Yeah.
Company structure, executive compensation, how the proceeds will be used, underwriter details, legal proceedings, everything.
The real nuts and bolts.
It ensures consistency and completeness in corporate filings.
And then there's Schedule B, similar idea.
Yep, Schedule B is the equivalent, but for securities issued by foreign governments wanting to sell bonds in the U.S.
Wait, governments have to register too?
If they want to tap U.S. markets, absolutely. Investors need to know about the country's finances, its debt load, political stability, anything affecting its ability to pay back the bonds.
So no free passes just because you're a country. Transparency for everyone.
That's the idea. Creditworthiness matters, whether it's a company or government.
Okay, that covers the 33 Act, the birth of securities. Now let's talk about its big sibling, the Securities Exchange Act of 1934. This one's different, right?
Totally different focus. The 34 Act is about the secondary market trading securities that are already out there. Think stock exchanges, brokers, ongoing reporting, and crucially, the 34 Act actually created the SEC.
Ah, okay, so it regulates the day-to-day trading and the players involved.
Exactly. And it starts, like many laws, with definitions. Section 3A is the dictionary for the 34 Act.
Defining things like what even is a security.
Yeah, and that can be trickier than it sounds, especially with new financial products popping up. It also defines broker, dealer, exchange. You need clear definitions to know who and what the rules apply to. Understanding the definitions is step one.
Like knowing the pieces on a chessboard before you play.
Good way to put it.
Okay, then Section 12. This sounds like registration, but for existing stuff.
Right. Section 12 requires companies of a certain size, measured by assets and number of shareholders or companies listed on major exchanges, like the New York Stock Exchange or NASDAQ, to register those securities with the SEC.
So this isn't about the initial offering. It's about ongoing regulation once a company is public and widely traded.
Precisely. And registration under the 34 Act triggers ongoing reporting requirements, quarterly reports, annual reports, letting the market know about major events, continuous disclosure.
Keeping the information flowing after the IPO. Got it.
What about Section 15, brokers and dealers?
Section 15 mandates that firms or individuals acting as brokers or dealers have to register with the SEC.
So you can't just decide to start a stock brokerage in your basement.
Not legally, no. The SEC needs to oversee these intermediaries. Registration subjects them to rules about capital requirements, conduct, record-keeping, inspections. It's about investor protection and market integrity.
Keeping track of who's handling the money in trades. Makes sense.
It's a key part of the regulatory framework.
And Section 15A, registered securities associations. Sounds like industry groups.
It is. Section 15A allows for the creation of self-regulatory organizations, or SROs. The big one everyone knows is FINRA, the Financial Industry Regulatory Authority. FINRA, right. They oversee brokers and dealers, don't they?
They do. The SEC delegates some day-to-day oversight and rulemaking authority for brokers and brokerage firms to FINRA. Think of FINRA as the frontline regulator for brokers, enforcing both SEC rules and their own conduct rules, all under the SEC's ultimate supervision.
Like a cop on the beat for the brokerage world, while the SEC is the police chief.
That's a pretty good analogy, yeah. They handle exams, discipline, rule enforcement for their members.
Okay, so those are the big acts. But there are specific rules under them that are really important too, right? Like Regulation D.
Ah, Reg D.
Ugh.
Yes, very important. Regulation D, under the 33 Act, provides exemptions from the full registration process for certain private offerings.
So ways to raise money without doing the whole public IPO thing.
Exactly. If you meet certain conditions like selling only to accredited investors or keeping the amount raised below certain limits, you can use Reg D exemptions, like Rule 506B or 506C. It makes capital raising much more efficient for certain types of issuers, especially startups or funds.
The VIP entrance for fundraising, basically. Less paperwork, less public glare, but only for certain players or smaller deals.
That's the gist of it. It's crucial for the private markets.
Okay, what about Rule 144? Sounds like another exemption.
Rule 144 deals with the resale of restricted or controlled securities. Restricted securities are those acquired in private placements, like under Reg D control securities are those held by company insiders, like executives or major shareholders.
So this isn't about raising new money, it's about letting people who got stock privately or insiders sell it publicly later.
Correct. Rule 144 provides a safe harbor conditions under which those shares can be sold into the public market without needing a separate registration. Usually involves holding the shares for a certain period and limits on how much can be sold at once.
So insiders can't just dump all their shares overnight and crash the stock?
Exactly. It allows for orderly sales into the market, providing liquidity but protecting the market from sudden shocks.
Then there's Rule 144A, is that related?
It is, but it's different. Rule 144A facilitates the private resale of restricted securities, but only among sophisticated institutions called qualified institutional buyers, or QIBs.
QIBs, who are they?
Think big players, insurance companies, investment firms, pension funds managing at least $100 million in securities. Rule 144A lets these big institutions trade restricted securities among themselves more freely without waiting for Rule 144 holding periods or volume limits.
So it creates a sort of private, high-stakes trading market just for the big guys. Does that concentrate power or just make things more efficient for them?
Both arguments are made. It definitely enhances liquidity for institutions holding restricted securities, making those securities more attractive in the first place.
Okay. How about Rule 145, mergers and stuff?
Rule 145 addresses certain corporate reorganizations, think mergers, acquisitions where stock is exchanged. It basically says that when shareholders are asked to vote on these deals and swap their old shares for new ones, that counts as a sale of securities.
Ah, so even though it's a merger, the company still has to provide disclosures similar to a new offering.
Yes. Shareholders are making a new investment decision. Do I want shares in this new combined company? So they need adequate information, similar to a prospectus, to make that choice. Transparency during big corporate changes.
Got it. Keeps shareholders informed when the company structure changes. Nearly there. Rule 147, intrastate.
Rule 147 provides a federal registration exemption for offerings that are purely local, kept within a single state.
Like that Colorado brewery example, selling only to Colorado residents.
Exactly. The company has to be incorporated and doing substantial business in that state. The offering can only go to residents of that state, and the money raised has to be used in that state. Plus, there are restrictions on reselling the shares out of state for 6 months.
So, truly local fundraising for local businesses.
That's the intent, helping smaller community-based companies raise capital locally without the complexity of federal registration.
Okay, last one. Rule 164 and free writing prospectuses. Sounds like marketing.
It kind of is. A free writing prospectus, or FWP, is basically any written communication about the offering that isn't the official statutory prospectus. Rule 164 allows issuers, particularly larger, more established ones, to use FWPs after they've filed the initial registration statement but before it's effective.
So they can use like slick brochures or presentations to drum up interest while the official docs are being finalized?
Pretty much. Think investor roadshow materials, term sheets, press releases about the offering, but there are rules. They have to direct people to the official registration statement, and the information can't contradict it. It allows for more flexible communication during the IPO process.
More marketing flexibility, but still tied back to the official disclosures.
Exactly.
Wow, okay. We covered a lot of ground there. So boiling it all down, what's the absolute main takeaway from all this?
I'd say the fundamental goal, woven through everything, is full and fair disclosure. The SEC wants to ensure investors have the material information they need to make informed choices. And importantly, remember, the SEC doesn't approve the merits of an investment, just the adequacy of the disclosure.
Right. Disclosure, disclosure, disclosure. And we saw the split. 33 Act for new issues, 34 Act for ongoing trading and market players.
And rules like Reg D and Rule 144 provide specific pathways, exemptions really, that try to balance investor protection with the need for companies, big and small, to raise capital and for shares to be traded efficiently.
It really is a balancing act.
Definitely.
Which brings us to a final thought for you listening. Think about that balance. How do you make it easy enough for companies, especially innovative startups, to get the funding they need to grow while still protecting everyday investors from getting burned? Where should that line be drawn? How well do these complex rules we've just scratched the surface of actually achieve that balance today? Something to chew on.
A very relevant question in today's markets.
Yeah. Absolutely. Well, that's our deep dive for today. Thanks for joining us.